Hi, Ira Coiner here, President and founder of Triathlon Partners. Thanks very much for watching this episode on Triathlon TV. And today's topic, we're going to discuss what has happened to the equity markets and the stock markets. Well, it's been a very tumultuous 6 weeks, right? And there's a lot of news that's come out in the last 6 weeks. But most importantly, let's sort of look at what's the net change on the market. During this span, we had the Nasdaq 100, the top largest stocks on the Nasdaq, fall 12%. Now they've rebounded, and right now I have on my charts that they're down just 4.6% from the 10th of July. But the S&P 500, a broader index, is pretty much flat since then. It's been a bumpy ride, but let's sort of break down what has actually happened in the market. What dropped that Nasdaq, and how has everything else performed? Because the volatility we had, a lot of people ask me questions. They get a little bit, should we take our money out? If you're in for the long haul, it's very important that you understand why these moves happen, right? And that's part of what we do. We want to engage and educate our clients to empower them. So to understand why these things happen, and then think, is this a long-term move? Is it not a long-term move? What was the impetus for all this? Now, as I said, a lot of things have happened in the past 6, 7 weeks since July 10th. We had President Biden step aside from the election. VP Kamala Harris stepped in and took the nomination. She finally, after the convention or during the convention, came out with some policies which basically look like Biden's. It's a little more generous. Trump's policies really haven't changed from when he announced during the Republican convention, which I believe was before that. The Middle East escalation hasn't happened. The big thing that has happened, and it's boring news, is the Federal Reserve first came out in that beginning of July that Jerome Powell went in front of Congress, kind of said that they were leaning towards cutting rates. It's very good for some parts of the economy. Other parts, took the brunt. It was take from Peter, give to Paul sort of scenario. But he was wary about the job market, and the Fed didn't cut rates. And then the job market came out terrible statistics, and they keep on coming out very weak. And the Fed hadn't cut rates. So everyone was really worried, what's going on? The Fed's going to screw up again, right? Well, they had their big meeting in Jackson Hole, right? The big meeting, and they came out and he spoke. The Fed meetings in September, but he basically locked the market into at least a 25 basis point cut in rates, which is the first time they cut rates since before COVID. And inflation looks like it's under control. And they're worried about the job market sort of creating a recession, right? Because unemployment has spiked a bit. It's still at good levels, but it has spiked quite a bit. And I want to look at what has happened in the actual equity markets and the interest rate markets, sort of give everyone a good overview of what's happened over this time period. Now, as I said, the Nasdaq, everyone knows these stocks: Microsoft, Apple, Nvidia, everyone's talking about. I don't know if people watch Broadcom. Tesla's going up and down. But all those big stocks collapsed. The index moved down over 12%. It's quite a lot. But the S&P is now back to flat. Let's look at all the components, what these happened. Now, the S&P 500 stocks has 11 sectors, right? 11 different parts of the economy. It likes to break it up into all these big stocks on the Nasdaq are included in the S&P 500. So that Nasdaq 100 is it's a big subset, but it's primarily technology based, communications based, as well as discretionary income, discretionary spending based, right? So happens those are the three sectors that are still in negative territory since that date in July when Powell spoke in front of Congress, right? And all right, they're down. And I have over here that let's go to IT, since is down almost 6%. And we're talking communications are about flat and discretionary is about down 2% since then. But the surprising thing, when we look at all the other sectors, we look at financials up 6%, utilities up 8.6%. Consumer staples up 5.7%, healthcare up over 6, industrials up 6, materials up 5, energy is a little bit different, but it's up 1, right? So we have this big split, and we have this split about companies that are cash rich on the big tech side, and we have companies that need to borrow money to continue their operations, have heavily capitalized assets, manufacturing companies, construction companies, that sort of thing, as well as small cap stocks, which need to borrow money in order to grow, right? They're in the growth phase, et cetera, et cetera. And those small cap stocks, which are commonly referred to, they watched on the Russell 2000 is the index it tracks, they're up 8.5%, right, since that day. So we're really talking about, when I said the Nasdaq 100 is down 4.6, and then the small caps up 8.4, we're really talking about a big shift in capital that moved from one to the other. That's 13% change. But otherwise, all the other sectors are up 6% versus that. So we saw a big shift. Now, what sort of is maybe rallied the market and come back is that the interest rates have absolutely collapsed. Even though the Fed did nothing in the beginning of July, markets forced their hands. They saw inflation numbers were coming down, right? And they see the job market being weak, and the Fed isn't going to get behind the ball because they've really screwed the pooch a couple of times in the last several years with COVID and inflation. So the market knows, the election coming up, they don't want to upset anyone who's in power. They want to keep their jobs if the party sort of wins. And they kind of really, I think, do want to do the right thing overall and don't like it when people lose their jobs. So from that standpoint, when we look at this, we're going to go to the interest rate market. Now, we're talking 6 weeks ago, the U.S. government, if their 10-year bonds, right? If you were lending them money for 10 years, the interest rate was 4.58%. On Friday, it's 3.8%. So it's down 0.78%, the interest rate. That's a big move, right? When we look at the 1 year, that's from 5% it was at, and now it's at 4.36. That's also a big move, right? Especially since the Fed is, maybe they go 50, maybe they just go 25, maybe they like to be gradual, they're very cautious old people, and they like to go 25, 25, 25, whatever it is. These interest rates are really the moves that have been happening and driving the market. So going forward, I think the important thing to do is when you look at the paper or you look at your statements is let's look at what interest rates did today, not just the indexes, because those interest rates will dictate how everything else moves. And how we've seen there's been a big rotation of what's happening. The more that interest rates come down, you're going to see old school economy companies in the industrial sector. You'll see the small cap growth companies. You'll see the value companies, pharmaceutical companies, all outperforming. They put up good numbers this year, and no one's really going to complain, I guess, if the market's very volatile, and they've done 6%. But 6% is within the last 6 or 7 weeks. So let's keep this in mind going forward. Let's see what happens with some more of the economic data that comes out. There's some big corporate earnings coming out. There's also a Fed meeting that comes out, and it's not necessarily how much they move. It's what they say and what they predict in the future and what they think inflation is going to be at. But I think we have to, as participants in the market and watchers of the market, we have to see they're really going to be focusing on employment numbers more importantly than inflation, because the numbers are coming under 3%. And I think from that standpoint, the target might be 2, but I think they're very content keeping it, as long as it keeps on coming under 3, they know that it's contained, right? So that's my opinion on this. And thank you very much for listening. I hope this was educational and helped people understand what was going on in these volatile markets in the last 6 weeks and put a frame of reference on everything going forward. So thank you very much for watching. We really believe in educating our clients so they understand these markets, as well as we like our stuff at Triathlon Partners. I like these acronyms. So, please, if you thought this was helpful, subscribe, thumbs up, friends, and followers. Yep, we love them. So please just click those buttons on the social media. We really appreciate it. Have a lovely and blessed day. And as my loyal followers know, the disclaimer's coming up. It's a very important part to read. I'm not so good at putting the disclaimer up quickly, but I'm really good at making sure we maximize all your assets going forward. All right, well, take care. Have a lovely, wonderful, and blessed day.